Capital markets are very weird. Actually, investors at this stage, they pay someone to take on their funds. It should actually be the other way around. And the reason is that many Eurozone sovereign debt are negative yielding. There are about 2,200 billion of sovereign debt which have a negative yield in late April. The context is that the ECB, through the quantitative easing, has launched a buyback program of 60 billion a month. It will be roughly 1,100 billions over the next year. This has nurtured a herding instinct. Market participants expect that yields will come down, and they are positioned for this. And sometimes it can actually make sense that people are chasing negative returns, especially when we speak about deflation. Probably you remember that only 6 months ago, the fear of deflation was crippling investors. Now, investors accept negative nominal yields as long as there are real positive yields. On the other side, what we have seen as well, it's not only about the fear of deflation. We have a new large player, it's the ECB. So many investors believe I can actually buy negative yielding instruments because somebody is left there who will buy it from me, and that's the ECB. Greenspan called this the irrational exuberance. Actually, purchases are not based on intrinsic value, but they are based on other people's market behavior. We have recently seen a huge rise in yields. Actually, some analysts called this huge rise in yields a Blitz crash. What we have seen is, if you look, for example, at the 10-year Bund, which was yielding only 5 basis points 4 weeks ago, it is yielding today roughly 60 to 70 basis points. Now, what does that mean? 60 to 70 basis points increase in a 10-year Bund yield means that the price has dropped by roughly 6%. 6% drop over 4 weeks. Many people use the Bund to safeguard their lifelong savings. And if you have lost 6% over 4 weeks, this is tremendous. In order to understand this, we should be aware that actually inflationary fears or deflationary fears have receded, partly because oil prices have gone up, partly because we see also a pick-up in the economic momentum of Europe. Europe has had a very strong first quarter in relative terms. Europe's growth was 0.4% of GDP compared to the US's growth of 0.2%. So clearly, Europe seemed to have escaped the deflationary slowdown, which many people were afraid of. A few weeks ago, we advised our clients that actually the bond bull market had gone too far. We were very much afraid of a snapback, and that's really what we have seen. Now the question is, will we see over the next 4 weeks once more a snapback of 70 or 80 basis points? Now we don't believe that. Why? The euro economy is still very fragile, and people have to take into consideration that the economy can splutter at any time. What we don't like about the economy is that many traders have taken the same side of the trade. So it's a little bit like lemmings. There's a herding instinct, and this means the market is very illiquid. From that point of view, volatility will be very high, and we recommend our investors to avoid this asset class.